Yeah, no. I cannot see your control panel.
Because
Yeah,
right
sorry.
now
Yeah.
my control panel's collapsed and yours probably is open. So mine is,
Gotcha.
yeah, just
Okay.
2 minutes.
So Joel, or sorry, Piero, you're okay then?
I hope so.
Okay.
We'll help, Piero. If you get stuck, we'll definitely help.
Okay, is there something that I can look at quickly, just to quickly glance over it?
Yeah, you look at the agenda, and then I just kind of, 10 seconds, just say, welcome to the International Model Investment Club. This is the agenda. And then I'll flip over to the presentation. I mean, meeting presentation slides, and then you can go from there.
Okay.
It'll be 2 minutes, 2 minutes, painless.
Okay, I hope so.
Then you'll say education topic is today is Isla. She's going to talk about share classes and buybacks. And then we have a stock study presentation. That's it.
Okay, Isla is presenting stock buybacks.
Yeah, do you see the agenda on the screen?
It's too small, I can't see it.
Oh.
Can you make it bigger?
So yes, I am presenting share classes and buybacks.
Or share classes and buybacks, okay.
Yes. Okay.
Is that
that's
better, Piero?
Yeah, that's better.
Okay.
Okay.
Okay, we have a minute.
Piero, for your information, please post information on our club's website.
Yeah. Jan, who dropped out of the club last month? I missed that.
John
Jan
Catterson.
So we had to pay him off. I didn't include that.
Oh yeah. Okay, next time.
Next month. Yeah.
And then everybody mute themselves except for Piero.
Okay.
I'm going to start the broadcast, Piero. Are you ready?
Yeah, okay.
Okay, here we go.
Oh, good evening, everyone, for the International Model Investing Club. We are kind of a virtual club that we meet. We meet for educational purposes. You'll be hearing about stocks and other issues and things. This is not really meant as a recommendation or endorsement on our part. We're just doing this for education purposes. And since we are a virtual club, we deal with virtual money because we have members throughout the United States, the East Coast, US, in China. We have people in the club from Canada. So currency conversions and taxes and all that kind of stuff, we don't want to deal with that. It's too complicated. So we just deal with virtual money. I would ask, the guest attendants to wait for at the end of our kind of meeting, we'll give you a chance to ask your questions and make your observations known to us. I think we're going to start off with the agenda. I think Isla is going to be presenting stock classes, share classes, and share buybacks. And then we're going to go to a stock study presentation given by Jay and Haney. That's about it from as kind of an introduction.
Sorry. Let me go to.
Yeah, the other thing I can mention is that all our meetings are posted on YouTube, and to get to that, you just type into the address, the search bar for YouTube. You say IMIC, International Model Investing Club, space Better Investing. That'll take you to our reservoir of videos that we post every month.
Do we get any money from YouTube for doing this?
I don't know.
We may not have enough followers.
Joanne knows.
And this is our disclaimer. We have this every month, so feel free to review, and then we can go on to ready now to do the treasurer's report. You ready?
Yes.
Ready?
I'm bringing my screen here. Okay, how do I take control of the screen? Okay.
We see your screen.
Yeah. Okay. Uh, okay, I'm presenting this month's treasurer's report. As of yesterday, I deposited $1,200 on behalf of 12 members. I did not know John left, but I will adjust the next one. We sold Disney half the shares. We cashed around $1,900. Payout is none. And again, I will take care of John at the end of the today or tomorrow. Our cash balance is piling up. It's a good chance to buy something today. We have 20,000 plus no new member. Our heat map looks little hard to read, but this is how heat map looks like. Again, cash is the largest box. Vertex is doing good, and then Meta, Google, Qualys. We have a couple of sectors missing. I will go through as we have, but this is the picture as of yesterday. This is our portfolio gain or loss. It's improving. We have only 2 losses, but many of them are gainers. I have a list of gainers in the following slide. Disney, and I know what is Disney going through, and LGA Homes, but they're kind of not bad. Disney is not bad loss. This one, I think I started including this for 2 or 3 meetings ago. Do not be concerned with this one. This is artificial because we did not pay off the members, and the blue one is the cost basis, and the red one is the our market value. Next slide is our gainers and losers more than 10%. I listed only more than 10%. Below 10%, I didn't include. We are doing very good with Vertex Pharma, Charles Schwab, and ResMed, and Meta, and others are doing very well. Amazon is a little less, and we have only again 2 losers, more than 10% of our cost basis, LGA and Disney. And this is the picture of our gains. I am kind of little curious. If we change this date, it is changing the picture completely. This is the we have to read this carefully. The top 2 lines and the bottom 2 lines. This is the period. That 1 star is the period during which it is averaged, and the second one is the shorter time period. Okay, so considering that, this is how our club is performing. This year, it's not as well as the indices, but 1 year basis, we are doing good. Lifetime, we are kind of equal. And these are I request you to pay the attentions to these these dates when we're reading this graph. The next slide is again, as this is a reminder, who may need to update. Meta is, I think, about to need for update. Paychecks need update. ResMed need update. I think the rest of them are after the last quarter. Okay.
Ready. I'm willing to take over John Catterson's Google there. Since
John Catterson. Okay, Google. We had to. We had to check the status with Christopher Sue. Qualys is doing good actually. Unfortunately, I cannot update, and this picks up the date that the stock watcher updated their SSG and pulls in.
Yeah, I thought I updated it yesterday.
Oh, Chris is here. Okay. You have to link it, Chris. You have to link it. I know you did the analysis. I looked at it, and I think you suggested hold, but you have to link your SSG to the website.
Yeah, on my iClub. I thought I did that, but maybe not.
Yeah.
I'll take a look.
And I think you and Joanne, I do not know who else, Mina has control on changing this assigner. Okay.
Yes, I can. I'll fix that.
Yeah. Okay. Also, since John left the group, you have to drop him from the list. Otherwise, it will deposit $100 for him also next month. I will do it tomorrow, but he will deposit a membership contribution for next month unless somebody deletes that name.
I'll talk to you offline about it so that I don't make a mistake with it.
Is he likely to come back, or is gone for good?
No, he's not. He's not. He's interested in crypto. That's his.
Okay. I'm scared of crypto. Okay. Okay. So yes, Haney said he will help out to take the John's name out there. Okay. Next one is, this is the PET chart I included. I think this needs some periodical review. Which ones we are doing good, what colors, and which ones we need to pay attention. I think we have at least every quarter we should spend some time, and once or twice I did after our previous member left. It will be helpful. Okay. Next one is, these are all pie charts. I extract them. These are the companies that we have. You can see that the blue one is cash. We are sitting on. We can consider buying some, and otherwise we have a fairly good number of companies. I know we want to limit the companies because of the membership. Next one is okay. This one, because Vertex is doing good, we have a largest percentage, but all others except the LGIH, we are around 5 or more than 5%. Next one is the sectors. Sectors, we are representing the sectors except 4 sectors we are missing. 11 minus 4 is 7 sectors we have. And I think Joel asked today, can we represent the
sectors?
Market, yes, market cap, large, mega cap, large cap, and mid cap and small cap in this one. But
Wait, no.
then I looked.
No, not this one.
I wanted, I was suggesting to have the companies, the actual companies, for example, communication services, what companies, what companies we have that fit under that category, like you have on one of the graphs.
Okay. Okay. These colors, I looked at it. These colors represent whether it is a mega cap, large cap, mid cap, small cap. Okay. The following slides will show that. But the finishing the slide, we have still the sectors missing are basic materials, consumer defense, utilities, and energy are missing from our stock list. Okay. This one is the industries. Industries, of course, a lot many categories. Again, this color indicates what sector, large, mid, small, or the mega cap they are in. This one is the company diversification. This one has a clear inner circle designating small, mid, large, and mega, whereas these colors are inferred in the other slides. The inner circle is missing. And for a recommendation made by the website, I included this, started including this chart where how much is the suggest small, large, and mid cap, 25, 25, 50. Okay, and our club has, these are the percentages I summarized: small, medium, large, mega. Okay, we should increase mega and large more, and small more, spend some cash. Okay, I think this, my last slide is this is the website recommended club. iClub recommended S&P 500 sector weighting. These are all 11 classes, and you can see the information technology is the largest always. I don't know. Yeah. Okay. Any questions?
No, that's great. Thank you very
Thank
much, Freddie.
Yeah. Thank you.
Now I'm going to turn it over to Isla.
Okay, so how do I do this? Show my screen. That works. Can everybody see the screen?
Yes. Well, no, you got to accept the. Did you?
I did. I said,
There you go.
I clicked
There
share
you
my
go. Yes.
screen.
Yeah, now we can see it. Yes.
Now you can see it?
Yes.
Okay.
There's
All
a
right.
bit of a delay usually.
Okay. So we're going to talk about little pieces of information about share classes and share buybacks. Where's my thing? Okay. So different words that are used. Shares are units of stock issued by a corporation that represent ownership. Different words. Stocks are generally used to refer to portions of ownership in multiple companies. For example, we own stocks in IIPR and BRTX. Shares, on the other hand, usually refers to ownership in a particular company. So in that case, we might own shares in Amazon. Equity is the term for the total ownership stake in a company. And our ownership stake, for example, in Amazon is 1/2 millionth percentage of the mix that they have out there. Now, stocks, shares, and equity by giving direct exposure to a company's performance, so through ownership. Exchanges facilitate the exchange of shares in publicly listed companies. Now, to become listed, you can do it in a couple of different ways. You can offer new shares for a new company using an underwriter circuit, which is, the thing that Wall Street likes to have companies do. You can offer a direct listing of shares as an IPO, or you can offer a direct listing of secondary offering of previously held investor shares without using underwriters at all. Or the company can merge with an already public shell company, often called a special purpose acquisition company, or SPAC. It was popular a few years ago. Using an underwriter syndicate is the most traditional method, and that's the one that Wall Street prefers, and most companies choose that method. Direct listings, on the other hand, are not as common, and they are less expensive. Spotify in 2018, Slack in 2019, and Roblox in 2021 all IPO'd through direct listings. A SPAC, special purpose acquisition company, is a publicly held investment company, and what they do is they acquire private companies, add them to their investment portfolio, and as soon as they add them to the portfolio, that company becomes public because the investment company itself is already public. So Virgin Galactic in 2019, DraftKings in 2020, and Hims and Hers in 2021 became public companies through mergers with SPACs. There's also a spinoff. So some companies have corporate units that they want to spin off and have that become a separate company, and that can be, those shares can be offered for sale in the market. Abbott spun off AbbVie, and eBay spun off PayPal, both of which are separate companies from their original parent company. So a few other definitions. Shares issued are those shares that have been sold, but shares outstanding are all the shares that are held by investors. Shares that are bought back are still issued, but not outstanding. If those shares that are bought back are reissued, then they are again issued and outstanding. Once those shares are retired completely, they are no longer issued or outstanding. Shares sold may not equal shares outstanding if buybacks have occurred. Now, the float is the common stock that is available to the public for sale, and that number is reduced by any restricted units. Restricted units are usually shares held in escrow for employees, but employees must stay with the company for a specified period of time to receive the shares, and the shares have no value at all until the employee vests with the company. And treasury stock has no voting rights, does not get any distributions in the form of dividends. It may be part of the initial authorized shares that were never sold, or they may be held to offer for sale later, or they may be some of the shares that have been repurchased. Now, preferred stock is a class of stock that doesn't have any voting rights, but it does pay a fixed dividend at fixed intervals. It's sort of a cross between common shares and bonds. Then many companies have authorized preferred stock. Fastenal has 5 million preferred stock shares authorized, none are issued or outstanding. Amazon has preferred shares, none issued or outstanding. Paychex, no preferred shares are listed as authorized. Google says it has 100 shares authorized, none issued or outstanding. That might be 100 million. And Meta has no preferred shares listed or outstanding. Now, publicly reported private companies, this is something I did not know happened. Is the SEC reporting only for public companies? It turns out it is not. There are private companies who are required to file reports for the Securities and Exchange Commission if they meet certain criteria. Companies with more than $10 million in assets whose stock is held by more than 500 owners, or companies that have issued public debt offering. These companies have to file with the SEC annual and quarterly reports. Google faced this requirement once it was founded, since it wanted to issue its shares to its employees, which would give it more than 500 owners while it was still a private company. Google chose to go completely public rather than be a private, publicly reporting company. They bypassed the traditional underwriter syndicate, chose an auction method, which allowed anyone, absolutely anyone, to bid on the shares. You did not have to be what is called an accredited investor in order to buy in the IPO. More on Google. On August 19, 2004, Google became a public company via an initial public offering. At that time, Sergey Brin and Larry Page agreed to work together at Google for 20 years until the year 2024. I can't find anything that indicates that they will be leaving anytime soon. The company wanted to use an auction method in which anyone could bid on the shares. The initial price point was expected to be $106. However, when they opened it up, there were very few bidders, and most of the bidders were at a lower price. So Brin and Page decided that they would offer their 19 million shares at $85 a share instead of $106 a share. The shares were sold in an online auction format that was built by Morgan Stanley and Credit Suisse, who were the underwriters, and the sale of $1.67 billion gave Google a market cap of $23 billion. Google opened the day at $85 and closed at $100.30. Uh-oh, it's not moving. Okay. Not moving. Uh-oh.
When you do your down
Yeah, I've been trying it. That's not working so well. That's what I was using. Let me do something else. No, that's not working either. Okay.
could do is maybe can you do escape and then
Yeah, I'm trying that now, and that's not working either. Wait a minute. Let me end the show and start again. Okay. Let me see if that will work. Okay, there we go. So now let's talk about Meta. Meta has two classes of shares. Class A, there are 2.2 billion shares, 800,000 of them are owned by Zuckerberg. Class B shares, 350 million shares, 300 million of which are owned by Zuckerberg. The institutional owners of Meta are, you can see Vanguard, Fidelity, BlackRock, State Street, very large companies. Zuckerberg only holds 6.1% of the shares, but he controls 61.1% in any given vote. Hypothetically, we own 19.4 shares of Meta. Owning 1%, we would have to own 22 million shares. Now, other share classes, voting is a very important thing with owning shares, but it comes in different ways with different companies. Liberty Media is mostly a media conglomerate company, and they have a very interesting set of share classes. They actually have 9 different classes of stock. And they call them series. So there's Series A, Sirius XM, Series A Braves, and Series A Formula One. They also have a Series B for each of these and a Series C for each of these. Series A shares are 1 vote per share. Series B shares are 10 votes per share. Series C shares have no votes per share. And they're pretty much the most complicated share class that exists at the moment. But then there are other voting per share can be determined by formula. So Malibu Boats and Interactive Brokers have formulas to determine how many votes each one of their shares hold. For example, Malibu Boats, their share class A is 1 vote per share, but their share class B is 61,083 votes per share. Interactive Brokers, their class A is 1 vote per share, but their class B is 3,414,443 votes per share. I have no idea how their investor stuff goes. Now, other ways of determining how many votes per share. There can be a time-phased thing where, for example, AFLAC, if you have 1 vote per share, when you originally buy the shares, it's 1 vote per share. But if you keep the shares for 4 years, it converts to 10 votes per share. Carlyle Companies, 1 vote per share, but if you keep it for 4 years, it converts to 5 votes per share. And Quaker Chemicals, 1 vote per share initially, but if you keep it for 3 years, it converts to 10 votes per share. Berkshire Hathaway, as you can see, their current price is $610,900, and that was as of Friday's close, 1 vote per share. Berk B at $405.54 at Friday's close is 1/10,000th votes per share. So there's a very large difference between owning Berk A and Berk B. Snap, on the other hand, has 3 classes of shares. Their class A has no voting rights at all. Their class B has 1 vote per share, and that can be converted to class A. I'm not sure why anyone would do that. But class C is for founders only. Those shares carry 10 votes per share, but they control 88.5% of the votes. And this is written into their prospectus. So anybody who wants to buy shares really needs to read the prospectus on these companies. Many companies, industrial type companies, only have 1 class of shares. More recent companies, digital and techie companies, have multiple share classes. So it's worth it to read the prospectus to find out which class of shares you should buy if you want to have a vote and a say in what they do.
Anitra.
It's Isla.
Oh, Ayla.
Uh-huh.
Are you still, your slides are not moving. Are you still on the Liberty
We're
Media
still
slide or
We're still on share classes in action, voting?
on Liberty Media slide, right?
Yes.
Oh, okay.
Getting
Okay.
ready.
Okay.
Moving it
Okay.
now.
Okay.
Okay. So buybacks. Buybacks have always been sold as a good idea for investors. They return cash to investors, they boost shareholder value, they increase the EPS by reducing share count, they can instill a lot of confidence and increase the share price because of that increase in confidence. They can be an efficient use of any extra cash that the company has, and share repurchases can be timed in the company's favor, unlike dividends, which can't be. Okay, so now some of the not so wonderful ideas about buybacks. They are an alternative, if you have extra cash, to spending that cash on the business, such as higher wages for employees. They're an alternative to paying a cash dividend to shareholders. They're also considered an alternative to mergers and acquisitions because you use the cash for buybacks instead of for mergers and acquisitions. Buybacks also can offset dilution that comes from employee stock options and equity grants. It can also deprive the company of liquidity that it may need to use when there's an economic downturn. Company credit can be weakened if debt is used to fund the share buybacks, because that debt does not generate any revenue. There's no way once you buy those shares back to generate revenue to pay off that debt. You still have to pay it off. Companies tend to buy shares back when the share prices are pretty high. So they don't necessarily make a good choice. They just buy back shares. And usually that happens when the price is pretty high, not a good choice. Companies may fail to invest in corporate resources like employees or other items that they have that are used to generate revenues. And it can become treasury stock, which can be used as stock options for key employees. Now, due to lower taxes through the Tax Cuts and Jobs Act, many companies bought more shares back without debt. They got a chance to keep more of the cash. They didn't have to borrow money to buy shares back, so they could buy more back without debt, which is a good thing. But due to the lower corporate taxes paid, feds had to issue more debt to fund the gap. Now, some people think that buybacks are a case of insider enrichment. And there is a worry that since buybacks disproportionately benefit executives and insiders who hold large amounts of company stock, decisions about buybacks really don't have the needs of shareholders or the company front and center. It's not the most important thing to them. And then there are the opportunistic share sellers, investment bankers and hedge fund managers, as well as senior corporate executives who benefit at the expense of continuing shareholders. Corporate executives could be charged with share price manipulation, except the SEC has adopted a specific rule that protects executives from being charged with such crimes. Now, on our particular portfolio, all of our companies have repurchased stock. Disney took a break of buying stock back from 2018 until most recently March of 2024. And we kind of understand why they did that. Schwab repurchased stock in 2019, 2022, and 23, and Amazon repurchased stock in 2012 and 2022, so maybe they'll only do it every 10 years. 6 of the companies in our portfolio show a steady share count, even though shares have been repurchased. Amazon and Disney have a steady share count, but they don't really repurchase very frequently. And Google, Meta, and Qualys each show slight decreases in share count, even though they bought some share back. So that's it. Questions?
Ayla,
Yes.
this is a very good presentation. First time I'm hearing all these things. This looks like a lot of details, Greek and Latin to me, non-finance guy. Are you a slide?
Non-finance person here too, yeah.
Yeah, I learned finance. I can learn a lot of things, but are these slides available to the club members?
I can post them.
Okay. Second thing is, what is a good reference? I did not know that there are so many share kinds. What is a good reference to read? What is a good reference to read? This class A, class B, voting rights and all non-voting rights really puzzles me sometimes.
Well, it took a really long time digging through a lot of different articles on just a general search, different articles, but it takes a while to get to the crux of it, because most of the time when you put a question into Google or to Bing or to whatever it is your source is, you get a list of articles, and they pretty much all say the same thing, and they may not answer the question that you have.
Now,
So then you have to adjust the question and change your words around a little bit so that you can try to get closer to the answer that you're really looking for. So it takes a while.
Yeah, Google is very highly helpful, but it's like spoon feeding. Okay, is there any article, book, or this
Well,
classification of shares and voting rights is a puzzle to me. I would like to read a comprehensive literature.
Well, Investopedia is very good about explaining various aspects of it. They don't have one article that explains all of it, but they do have separate articles that explain different parts of it. Corporate Finance Institute is another website that has a lot of information about share classes and share buybacks and how shares actually work on the market. So those are two of the main that I ended up using. But again, you might have to, dig through a lot of stuff that is not really helpful to get to the sites that actually have the information you want to have. And some of it, I actually had to dig into the 10Ks and the 10Qs to get the information.
Yeah, I was
If
surprised.
you, Ready, if you look at any university level corporate finance textbook, you'll find basics of this.
Yeah, Henny,
I know that
I
for
was,
know
I
that
was
for
surprised to,
sorry, go ahead.
I was surprised to see her presentation. Zuckerberg owns 300 million shares out of 350 Class B shares or something like that. Okay, that
Yes,
means
he does.
he has a
Yes,
full
he does.
control. He has full control.
Actually, but again, he doesn't own the number of shares that he owns is not as large as some of the institutional owners. He only owns 6.1%. However, he controls 61% of those shares, of all shares. So anytime there's a vote, he's in charge. Anytime there's a vote with Snap, they're in charge.
Yeah.
Just the way it works. And most of the techie companies are the companies that have dual and 3 and 4 different share classes, and most of them have a class of shares that is just for founders, and they have a class of shares that may be for their key executives, and then they have the common shares that they'll sell to you and me. Google has a class of shares that is only for Page and Brin, the founders, and those shares are not inheritable. So the control that they have over that company will not necessarily be inheritable by their children. So I don't know if they've changed that recently, but that was how it was originally set up. And I think they set this up long before they even had any children. So they may have changed it since then because they both have children now. But originally it was not to be inherited, and the control could not be passed down.
Yeah,
okay, I have to interrupt you because we're a little late getting started on our stock study presentation. That was a fantastic presentation. We'll post it to our drive and then we'll hand it over. Jay, do you want to go first or Hanny on your stock study?
I'm just gonna go first to explain.
Do I have to
how
do I have to send this back to somebody somehow?
You can send it to me and I'll post it and then
No,
send a link.
how do I stop the share? That's what I'm interested in.
Oh, you don't have to do anything.
Oh, good.
You don't have
Thank
to do
you.
anything.
Excellent. Thank you.
So I'm just going to explain how we came up with the companies that we did. Then Jay is going to do the first company, and then I'll do the second one. So this screen, if you can see my screen, it shows the stock ideas page from SSG Plus. Can everybody see that?
Yes.
Yes,
Okay.
we can.
So there are 6 predefined screens, quality, value, and so on, down to A-list stocks. And if you click on this little question mark, it shows you what the criteria are for each of these screens. So what we did was we ran all 6 screens and then took the results, which are all here. You can see I'm scrolling through this spreadsheet. And then I just took out the unique tickers and counted how many times they showed up in various screens. So, for example, AX, and I don't know what AX is, but it showed up 5 times. And then these companies showed up 4 times, and so on and so forth. Okay. So what we did after that was kind of looked at the top companies 5, 4, 3, and 2, and that may or may not be a good approach. I don't know, but kind of focused on those. The other thing we did was value line screen, and so there's a value line screen predetermined as well, which is it's a valuation type of thing. So it's cash flow 5-year growth rate, EPS 5-year growth rate, sales, projected low total return. So the minimum return over the next 3 years is like is greater than 10%, and then timeliness, and came up with this screen. And just doing sort of a visual analysis on all of these things, we landed on information, or you can see here, software and IT services. That was just kind of a personal thing. We just went through these, and these things looked kind of good. So then we did some valuation metrics and gave each company a score. They got a total score, and then we ranked them, and then looked at the top half of the rankings. And you can imagine, like, going through all this stuff, we didn't have a clear way of, nothing jumped out, let's say, put it that way. We looked at this company, SPNS, and decided, okay, that seems kind of the most interesting one out of the bunch. And then when we looked at it further, it didn't look that great. But looking at brokerage reports for SPNS and other sources like Morningstar, they mentioned competitors. So we started looking at the competitors that were mentioned, and this industry, software and IT services, is very what's the word? Not the opposite of concentrated. It's very diverse. A lot of small companies. There's a few large players, but they're mostly mid-size and small. So it's kind of hard to find direct competitors. But we ended up with these 4 in yellow: CACI International, and SSNC, and Genpact G. And so those 2, SSNC and Genpact, are the ones that we are going to present today. So that's how we came up with them, in case you're interested. The other thing we did was look at performance of some of these companies versus the S&P 500. That wasn't very helpful. Then the other thing that we did was we developed this spreadsheet, which summarizes all of the earnings by year for various companies that we looked at. So and these sources are right off the SSG. So if you look at the SSG at the top, where it says, we have member sentiment, Market Watch, NASDAQ, Seeking Alpha, and so on and so forth. Where it says E-Trade, I have an E-Trade account, so I was able to get some information from that. Now, whenever you do this and generate this kind of spreadsheet, you have to be careful, because a number of these sources are actually duplicates. So you kind of have to look at the numbers, and if they're repeated, like they might be getting the information from somewhere else. So a lot of people get their information from Zacks or Seeking Alpha or what have you. The source of the information is usually something like FactSet or Bloomberg or something like that, but those are very expensive paid services, and then these websites pay for that, and they kind of provide it to the general public. So some of these are repeats, but we then took the compound sort of annual return and did a calculation here, and this is just a check on the calculation, but looked at, so for example, this one has 3 years of data. Well, 4, but 2023. So you take the growth rate between 2023, 24, and then 24 to 25, and 25 to 26. So that's really just 3 years of growth. And then you calculate the compound annual growth rate. Some of them, like Seeking Alpha had, what is that? 1, 2, 3, 4, 5, 6. So 5 years, and then just average them out. And those were the growth rates for earnings that we used. If you go this route and summarize all these earnings growth rates, you actually don't need to figure out what sales growth is. I can show you that later on, but because sales growth rates in the SSG are hard to come by, not a lot of analysts project that. So by doing this, you can eliminate the need to look for sales. Okay, and I'll show you that when we do it, but it's kind of obvious. And that's it. So I'll hand it over to Jay, and she'll do the first company. Okay.
So we decided to study the technology sector. The industry is the software, information technology and software services. Kenny already talked about why we picked the company and the industry that he mentioned. I just have one slide. I think this industry a little bit intuitive. We all know what the compass is. And mainly we're going to present 2 companies. I'm going to present the Gimpact, and Henny's going to present SSNC. The slides on the website we can share. This is basically talking about technology information industry, all these services. We are very familiar, all of us have been doing the investing, in IT consulting, IT service, software development, cloud computing, cybersecurity, data analytics, and BI, business intelligence, and IT support maintenance. Those are the services are in that technology information industry. Information. So for Gimpact is a spun off from GE in 2005. So they are a information technology services, mainly provide business process outsourcing, IT and consulting services to very wide range of industries across in different industries across globally. And they have about 129,000 employees working more than 35 countries. So how does this company make money? They are generated revenue from outsourcing their business, technology, consulting, advisory, and analytics and insights, and they also have their platform solution. They call something called digital lab transformation. That's what they focus on. Which in their revenue mainly categorized under these 2 services. They call it, and I got this information from their 10K on their website, investor website. I don't find any PowerPoints or presentations, and so I looked at their latest 2023 10K. Basically, they have 2 services they call digital-led transformation. These 2, the 2 services, one's called a data tech, artificial intelligence services, another one's digital operations. So they break into about just 50-50, very close, 45, 56. The industries that they serve mainly also categorized in the 3 areas. One's the high-tech manufacturing, financial services, and the consumer and the healthcare. On their company's website, they do list very detailed what those are. From their 10K, I was able to just summarize what they have based on their 10K. The revenue by region, and based on the 10K, the last 3 years, 21, 22, 23, based on their revenue, I generated this chart. From this chart that we could tell, India they are made as they are dominant region to generate their income, generate their revenue. They do have a business in US, UK, very close, about the same, and China and other regions. Mostly they come from India. Also, their CEO, there are few major leadership, there are few leaderships that are from, I couldn't tell if, based on the name, I just make assumption of India, but the CEO, it is. He is pretty new CEO, and I'm not sure if he based in India, but their companies, they are the revenue mostly are from India. There are a few things that I have done for the stock study before I did the SSG. I used Babu's approach to study give a 5-3-2-1 statements. I also looked the financial. One thing that I did, I should show is that I will show you at the end. I did the financial ratios because I want to see if this company passed those financial ratios. So what do they look like? Now you are talking about it. I should show this first. This information is on Morningstar. The path, actually, Morningstar has a different path now. Haney just corrected them. We used to call it operating efficiency, now it's called probability efficiency. So Haney was able to correct it because I used the wrong old template. Haney was able to correct the path if going forward we want to continue using Bagu's financial ratio to evaluate management. So you want to make sure grab the newest template. So anyway, Haney was also able to implement the scores. And then once you copy paste the financials for the last 10 years, it will automatically give you the color green, meaning that it's satisfied to meet the criteria. So the first criteria is ROE. Although in 2014, a little bit under 15%, but it's very close. So I decided not to, I decided just wait, take a look and what those are. The second criteria is ROIC. It's also very close. And the third thing is the free cash flow per sales. Greater than 10%. There are 2018 did not meet that criteria. Actually, that's 2018. I don't remember what happened 2018. But anyway, overall, they are very, like a 2023, very close to be 10%, but not quite there yet. Although to look this, we did not get like a 10 for all to satisfy, the top 3 are satisfied, but overall it's not too bad. And then I decided to carry on. But I'm using these financials as a judgment, like to gauge how are they doing. So, for example, I do look for each of them just to see how many of them, based on Bagu's ratio, are being qualified. Which I do have a slide to focus on. I did not look. I looked the trend as last 10 years, but I also focused on the 2023. How are they doing? So, for example, gross margin to meet the 50% is very difficult. For this company, they are greater than 35. And we looked at a few companies to compare. It's very hard to find, at least the 3 companies we studied, none of them, the gross margin greater than, this is the best, is greater than 30%. So I decided, although looking the score based on this chart, it says, hey, did not meet the minimum score. But minimum score for us is to make sure that we pass the top 3, and then the rest I would just gauge. I continue the study, which I can show you. So I look at the cash flow for their purchase property, plant, and equipment. They actually, compared to 2022, they have increased 9.5%. They did have acquisition, and they have spent $682 million. They have buyback shares, also increased 5% compared to last year. they pay dividends. Their dividends also increased. And debt reduction, they were able to pay long-term debt. I saw at some point on the 10K, and just right before the meeting, I forgot to write down the number, so I was decided to get that number, but I didn't get a chance to do it. But I remember they are paying off the debt, as you can see on the SSG, the 2023, the debt went down. And on their balance sheet, the goodwill per assets, it was about 35%. Accounts receivable increased to 12% compared to 2022. Oh, it's right here. Sorry, I had it twice, two different places. Long-term debt decreased 18.3 million. On their income statement, on their selling, general, and administrative expenses. So I try to figure out, because it's the IT company, I try to figure out how much did they spend on R&D. Looking at their 10K, they did not separate them. They just all lumped them together and specified that included investment in R&D. Actually, they decreased to 2.7% compared to 2022. Diluted share account also decreased from 188K to 100, decrease about 3,000. Point of view is that this company is growth by acquisition. Another thing I did was I using the Buckles vital signs for the last 5 years average. So the return on equity greater than 15% is good, greater than 20% is better. So this company ROE is at a 20%. Free cash flow return invested, we return on invested capital was greater than 10. This company is at the 11.9, the last 5 years average. So I calculated the last 5 years. Last 10 years did not meet that criteria, as I just showed you the financial ratio, but last 5 years they did. The free cash flow margin greater than 10 is good, so they are 11%. Free cash flow per net income. So we are looking at 1.0. So we're looking at 1.0. They are able to meet at the 1.0. It's very close. But in the 2023, it's at the 0.68. Something happened in 2018. So let's ignore that for a moment. And I was just looking at the last 5 years that 2023 did not meet that steady greater than 1%. Last thing I did was their net margin greater than 10 is good. They average at 9.7. 2023 they have a 14.1. So and then I did the last 10 years financial ratio. I just showed to you. These slides, we did the benchmark comparison for the profit to compare with peers and compare with the sector in different, just look at the different angle to, with peers, sectors, how do they do? So GPACT is a bit ahead compared to peers in the sector. This is revenue growth, compared to revenue growth. Is overall also performing overall. Henny helped me with this pair benchmarks. If Henny help me remind me, the pairs is like, we know it's exactly like a 2 or 3, or is like?
No, it's a larger group, and so the easy thing to use to kind of get to understand this is you have the 3 colors here, the company, G, and then its peers and sector. And on this scale, you can see where they stand. So, but overall, they're actually in growth, or it's not bad compared to some of, there's a number of metrics. You're not going to meet all of them, but if you're at the top end for 2 or 3, that's usually a good sign.
Then the next is the variation. If you just not looking these numbers, just looking the color. So for G is the 3 out of 7. So that is G, and then I'm going to show you. Interesting. I got to see. Oh, I fixed it. I thought I have the same issue as what
I
Isla
have a
has.
question.
My screen. Yeah, go
I
ahead.
have a question to. I had a question to Henny. I don't know whether I should wait until presentation is completed.
You can. Is a question for? Oh yeah, I am going to show you the SSG. I also did it first time as well. And
Question to Henny is, Henny, this is a $5+ billion market cap, 131,000 employees, and per employee revenue is around 30,000 per year.
I didn't do this company. Jay did. You have to ask Jay.
wait. What was the question?
Okay, per employee income is about 30,000. Okay, and this is IT company, and IT company generally very well paid employees. 30,000 per employee revenue.
Oh, how did you do that? How did you calculate that?
Total revenue by number of employees, which is 131,000, I think.
Keep in mind when they talk about 130,000 employees, that includes the people that, clean the office and, manage the parking lot. And then on top of it, you're in 35 countries. And so in some countries, the cost per employee is a lot less maybe than in the United States or North America. So, but
yeah, sure. And moreover, it is headquartered in Bermuda. I always little wary of Bermuda companies, but okay.
Hang on, I'm doing the calculation. My divided by 129,000. How much?
Yahoo says 131,000 employees, full-time employees.
I don't know. I got this number 129 from their 10K, the latest 10K.
Okay, that's close enough, but okay.
Divided by, are you saying that 24,000? I cannot, why I cannot?
31,000, my calculation per employee revenue.
And I don't know if you can calculate like that. I'm not sure.
Okay.
So
G,
I don't know. That's an
okay.
interesting question.
Total revenue past 12 months is 4.5 billion. 4.5 billion divided by 130,000 people.
Mm-hmm.
Yeah. Okay. That's how I arrived. Okay.
I know. I want to ask. My question is: do you think that we can take the average like this? I don't know.
Can we move on so that we have time for Hanny's presentation?
Yes.
Can you table this?
Maybe Baku can answer you when Baku's turn. I don't know if we can calculate average employee income like this. Mathematically, yes, but I don't know if that number makes sense.
Oh, wow. This is a spin-off from GE. I retired from GE. Okay, interesting.
Yeah, spin-off from GE, yes.
Okay.
So the SSG, I did the first cut as well. And my forecast, although like Kenny said, some of them redundant. I looked at ones that I usually use, Valueline, Zach, and Yahoo Morningstar. Not all of them doing sales forecast or revenue forecast, but they may do EPS earning forecast. My projection mainly I used is using the Valueline. I used the Lynch's method to calculate the sales in backwards. I'm calculating the pre-tax profit margin using their project tax and calculate diluted share. I modify all that. based on that, I was able, also I'm using value line to calculate the compound annual growth rate, which come out with 6%. So roughly aligned with what some of the analysts I looked, and also the sheet that Henny was showing. But you need to know like how many years are they projecting. So anyway, I decided to use the 6% as for their forecast, and the last 10 years is at 8.5. And for the EPS, I made a few changes. One is that I calculated the pre-tax profit margin. I'm using 21% as a calculated in the next 3 years, and I also did the outstanding share. I calculate that as well. So I made a modification. It come up with a 4%. And then for the next page, this price, as when we first studied this stock, the price about 31, 32, and upside down ratio is about 3 to 3. Actually, the last Friday that dropped another $1, roughly maybe less than $1. So I adjusted the P again. So the last 4 or 5 years, the P was very consistent around the 30. 2023, the P dropped to 14. I decided, okay, I'm just assume that your high PE for your next 5 years, just using 14, what does that give us? So I using the 14 as the high PE. With the low PE, we did the calculation, used about 20% of the current price. This company does pay dividends. The payout ratio, I just using the last 5 years average. It gives us 4-to-1 upside down, and annual return is about a little bit under 16%. Using high PE, if you're using low PE, it will be about 11%. Okay. Do you have questions?
Jay,
Piero.
Jay, can you go back to the original graph where you're graphing the sales and PEs and yeah, you see the last year in 23, all of a sudden the earnings per share jumped way up. Any reason why? Because you know the pre-tax profit stayed the same. So why did earnings all of a sudden jump so high?
I did not look.
Take a look at the. Can you graph?
If you look at the difference between the two, right?
Yeah.
Isn't that cost?
Well, the pre-tax profit, right? That takes it takes into account everything, all its costs.
Jay, did you look at the value line numbers? Because value line numbers discounts the special items like tax write-offs, things like that, one time, whereas Morningstar doesn't do that.
I did. You looked at the value line.
Yeah, okay. The value line adjustments, go to the bottom of the page. It will give you one-time adjustments and it takes them out.
Where is one-time adjustment?
Okay, right there. 21 5 cents, 22. I can hardly read. 8 cents, 23. Next 23 43 cents. Includes. Okay, you have to. Yeah, you have to. Okay, what is the next B item says? Includes. B.
Where are you looking at? I don't know where.
Includes intangibles. $1, 1.74 roughly, or $9 per share.
Okay, that $9 per share is added.
Yeah, includes intangibles.
Yeah.
Okay. Oh, Jay. Yeah, can you graph the amount of shares outstanding? And take a look here at the value line. It says the average number of shares. Where is it? Average. PE ratio, average annual dividend, shares outstanding. Where the heck is it? Cash flow, earnings, dividend per share, capital expenditure.
Right here, 172.
Okay, 172.
Uh-huh.
Okay, so that might be an explanation, maybe. But see if you can graph the number of shares outstanding on the SSG.
How do you, oh, okay, let's see.
Yeah, here on the right side.
Yeah,
See the margin there? I think it's going to be, yeah, shares outstanding. Yeah. Yeah, so the shares outstanding are going down. That might be an
Mhm.
explanation for the increase in earnings.
You can see that on the second page.
Yeah, but
That's a pretty
how,
large jump in earnings for a
no,
very small decrease in shares, though.
yeah, number of shares, small decrease does not make that big a jump. It is because of the $9 adjustment.
I'm
Okay.
sorry, I did not catch this three. Otherwise, I will study it. I did not notice. I did not even count this 12%. I felt like, oh, I just really focused on my projection, and using value line. I did not even look. I did not notice that.
And you're gonna have to dig into the 10Q and the 10K to figure that out.
Yeah, I did
The
not.
balance sheet
I
and
will
the cash flow statements and that stuff.
Yeah, but
Yeah.
if you to Reddy's point, right? If you take $1.88 in 2022 and you add 4%, you get $1.96, which is more kind of in line.
Oh,
Right?
can I do that? Can I just go ahead to I can modify the data, right?
You
Yeah,
can.
you can if you yeah, you can take that $10 out or 9, whatever it was, and
Okay. What is the value line?
Do I
Yeah, but
look
where
at the
is
annual?
it? Where
This
is
is a
it?
quarter. Let's do
What
the
is the
annual.
What is the value line EPS space?
Yeah, EPS right here.
Value line.
What do I,
Yeah, value
what I
line EPS.
Yeah, but that's the actual EPS that they earned.
No, this is Morningstar.
No, they used
Adjusted,
they adjusted it, added back some intangibles.
Yeah, these are the
Everybody does
gap.
that all the time, though. Most companies do
Right,
that
but
all the time.
that's not real
Okay.
money.
This is gap. Non-gap, which is this one.
Yeah, what is
2020,
GAAP? What is the GAAP earnings?
23. See one. No, go a little bit high, little bit up.
It's 410, isn't it?
Little bit up. Okay.
410.
1 second.
Earnings per share, 410.
No, 298 versus 3.65. If you plot these 2.98, 3.65, 2.74, see these are totally different from Morningstar numbers. You have to plot these numbers to get the good picture of. Okay. Yeah, you have to change all the EPS to the value line. These are one-time taken out, one-time adjustments taken out. The true business EPS.
What do I change for 2023?
You have to change all this. You have to change all EPS compared with value line numbers. See this value line numbers? They're changing very smoothly. They're changing very smoothly. No jump.
That's funny. You can say 2024 is 305.
Yeah, before that 296, then 274, 245. There's no big jump. There's no big jump anywhere.
Okay, gotcha. Yeah, regardless though, even if I change it, that doesn't affect my forecasts.
Okay, that's a different story. But this graph will look different.
Okay. I can do that. When Henny presents his, I can change that.
I gotta stop you guys now because now we only have like less than 20 minutes for Hanny's.
Okay. Henny, do you want to go ahead to present yours?
Yes, please.
That'd be good.
make myself a presenter.
Yeah.
Make presenter. Show my screen. Okay. Let me know when you can see my screen.
I can see your screen, Annie.
Do you see 1 or 4?
We
I
see
see
international model. Oh, and then we see SSNC. We see international model investment.
Okay. All right. So I'm gonna escape from here.
I-
Okay. I'll just use this then. I was gonna make a larger one, but okay. So I'm doing SSNC. Their motto is no offense, but we do operations better than you do. So this gives you a hint on what they do. They basically do all your operations, front office, mid office, back office, HR, all that stuff. That's what they do.
Better than you.
Better than you. So you outsource. What they're saying is you should outsource all that stuff to us. They have about 20,000 clients, 27,000 employees, and they work primarily in the financial services. They do a little bit in healthcare, but in financial services, there's about $45 trillion of assets that sit with various financial companies. And all of the processes and so on are done by this company, if that makes any sense. It'll make sense as we go along. So these are the kinds of clients that they serve. So hedge funds, mutual funds, wealth managers, family office, insurance companies, and you can see this little thing is healthcare. Now this graph is from a presentation that was done in 2018. I could not find a similar one that's more recent. That was kind of the last investor presentation that they did. The rest is all sort of just looking at their 10K. This just shows you that a lot of the financial companies rely on them. So 9 out of the top 10 brokers use this company for their back office stuff. 95% of all US municipal bonds use them, and so on and so forth. I won't dwell on this. Here's their client base, or some of their client base. Again, this is in 2018, so it's not updated, but gives you an idea. So Fidelity, JP Morgan, BMO, which is one of the largest Canadian banks, one of the top, I think, 10 or 12 in the world. CIBC, another Canadian bank, ING, you've heard of, Citigroup, so some big clients. What are the drivers in this market? Well, a lot of people are getting wealthy globally, and a lot of the wealth managers, they want information anytime, anywhere. So a lot of increasing regulatory burdens, and then there's a lot of information that's moving onto the cloud. So these are the kinds of things that are driving their business. This is just, I won't go into this, but they have a whole portfolio of software solutions for their clients. So, portfolio and investment accounting and analytics. So if you're an investment firm and you've got all these clients and you want to know, kind of have some statistics about your clients, the size of the client, how much they're investing with you, and so on and so forth. Customer relationship management, retirement software, trading software, et cetera, et cetera. A lot of stuff. Professional services, which is really their bread and butter, and that's the majority of their, that's the kind of their largest revenue source. Okay, so basically what this is consulting. So you buy one of these software products, and then they send a team in and they help you, train you on it, they install it, and so on. Okay, next slide. They do a lot of acquisitions because a lot of the software is very specialized. So they don't develop it in-house, they just go and acquire companies. And this is, again, a timeline up to 2018. I couldn't find a more recent one. The different companies that they acquired, their biggest one so far was DST Systems for $5 billion. So that was, I think, even till today. Where do they work? So United States, Canada, and the Americas, Europe, Middle East, and Asia and Japan. Their headquarters are in Windsor, Connecticut. I have no idea where that is.
8 miles from my place, my residence.
There you go.
And 2 miles from my workplace.
There you go. Revenue mix and gross profit margin. So you can see the software services are about 82%, and the licensing and maintenance is about, and the software licensing, because they don't just give you the software, you have to license it year by year, is about 20%. So this is recurring revenue stream. So they have a high retention rate with their clients. Once you become a client, it's kind of hard to leave them because you make a big investment. They have these teams training you and so on and so forth. So it's a steady revenue flow. Oops, sorry. And these are just the amounts. So like about $5 billion in the services and about $1 billion in software. And then their gross margin is about 48% roughly, so not bad. Some market risks, and I apologize for this, should say rates. I'll fix that. That's one benefit of, so they actually hold some money in bank accounts for their clients. And I didn't really understand it, and it's not in the 10K. I don't know exactly why they would hold their clients would give them money to hold, but they do hold daily balances up to $1.7 billion. So if you have 100 basis point change in interest rates, these are high interest rate savings account that they hold these balances in, you could see a 9.4 million change in net income annually. And then they also have about 4.7 million or 4.7 billion of variable rate debt. And again, if interest rates were to increase or decrease by 100 basis points, that's a big hit, $48 million in interest costs. They have about 49 million invested in equity securities. And if those equities were to change, say the fair market value was to drop by 10%, you'd see $3.6 million in net income change. They have some exposure to foreign currency, but it's not material. Most of their transactions internationally occur in local currencies because they buy these local companies and subsidiaries. They have a lot, about 31% of their revenues from outside the US. Most of that is in British pounds. So they have some exposure to the pound, but it's not a big deal. Okay, I did the same thing as Jay. If you're not familiar with this, and that's mostly for our guests, this was something that we got from Ron Bruin, may he rest in peace, and Bakul. So you take the cash flow statement, you make 5 observations, and then you do what's the next one? Income statement, balance sheet, 3 observations, income statement, 2 observations, and then after you make all these observations, you have a point of view, and Jay did that with hers. So what I noticed from their cash flow statement is that they're repaying long-term debt, and they're buying back stock. They raised their dividends for 7 consecutive years. A negative is that their stock-based compensation, which dilutes shareholders, has increased over the past 5 years. They're collecting faster from their customers, which is good. Their net operating cash flow is not consistent. It jumps around quite a bit. And their free cash flow has decreased over the past 5 years. So 3 negatives and 2 positives. As far as the balance sheet goes, their current assets exceed liabilities over the past 5 years by about 6%. I took a 5-year view on all of these 3 observations. Their book value per share has increased over the last 5 years by about 41%, and their debt to equity ratio has decreased from 1.8 to 1.1. So three positive trends. And on the income statement, gross revenue grew by 61%, which is a 10%, that's over 5 years, which is about a 10% compound annual growth rate. Sorry, revenue, and then gross income grew at about 13%. So they have a healthy profit margin. Their organic revenue growth is about 4.5% and about 6% through acquisitions. So it looks like they're mostly acquiring other companies, and that's how they're growing their business. Okay, then I did the same thing, the benchmarks. This is profit. So if you just look at the trends here, they're at the top with respect to peers and their sector, so they're profitable, good profit. Their growth, not bad. You have 1, 2, 3, 4, 5 out of 6 growth metrics, better than peers and sector. And valuation, again, not bad. You have 4 out of 6 metrics. Here's the Bakul ratio, and if you haven't seen this before, that's just Bakul Lala, who's a mentor to the club, came up with these 10 ratios to evaluate management. This company did not fare well. This thing is if you've ever heard Ken Kavula speak, he talks about barbed wire fence, which is the up straight and parallel. You have to clear that barbed wire fence before you can do further analysis. And in our case, the barbed wire fence is these 3 metrics: return on equity, return on invested capital, free cash flow to sales. They had pretty good, they exceeded every year for the last 10 years on free cash flow to sales, but failed on the other 2. I updated this spreadsheet, these what are called breadcrumbs, which is the URLs on Morningstar have changed. Morningstar changed the names of these things, and so I updated this. And the other thing you should note is that Morningstar talks about CapEx as a % of sales, but the number is a ratio. It's not a percentage. Some of these are written as percentages. That screwed me up because the spreadsheet has a lot of formulas in it to get these colors. If you meet the metric here. But anyways, that's a minor thing. So not great with the 10 ratios. And I didn't delve into it because it was just Jay and I doing the study this month, so we were kind of scrambling to get everything done. As far as valuation, Morningstar gives it a 4. So they're saying that it's undervalued by a 25% discount. I dug around and got 14 valuation models, things like DCF. There's a whole bunch of them. I won't go into them because of the time. If you take the average of these 14 valuation models, they range from a price of $54 to $114, and the average is 78. So this agrees with Morningstar. It says the fair value is 82. Here, the fair value based on these 14 models, the average is 78. So it looks like it's undervalued by 21% using this, and Morningstar says it's 25%. So that's close enough. Now let's see, where's my SSG? Right here. No, that's my Fairfax County, sorry. Where's my SSG? Okay, hold on 1 second. Give me a sec. I had it up and it disappeared. It's right here, SSNC. Actually, my studies. Bear with me, I'm just pulling it up. Sorry for that. There we go. Okay. So I showed you earlier the spreadsheet with all the earnings. The reason that you project sales in the SSG is so that you can do the preferred procedure. You put in the sales number, and then you can play around with all of these things and come up with earnings growth rate, compound growth rate. Well, you can avoid all of this if you can put whatever number you want for sales if you have a good number for EPS. So I took the average of all of the sources. So Value Line, Morningstar, NASDAQ, et cetera, and it came out to 11.3% for earnings. I could have played around with these based on value lines, but the problem I have with value line, it's the opinion of just one analyst. So by using this, you're getting a cross section of analysts rather than just one. And so now this is where it gets a bit tricky. So looking at the PE ratio, it's 24 is the current PE ratio. The average 5-year is 25. And looking at kind of these two, it's pretty steady between the low and the high. So I use 25, and I got a high price of 107, and currently I think as of today it was 61.33. And this thing doesn't update to today's. It just updated till Friday, but I know it's 61.33. Now, where it gets a little bit interesting is the low price. So I think this is pretty conservative, using it's 24 and the average is 25. But if you, depending on what low price you use, right now it's a 3.2 to 1. But if I make this $45, reduce it by 1, you get a hold. It's 3.1. If I select the 80%, which is 20% drop, and I looked at the chart, and 20%, it's about $49, as they say here, which is not bad. If you do 49 for a low price, you get 4 to 1. So it's really up in the air. But if you look at the even at 4 to 1, it's 13% total return. So it doesn't really meet our. We're aiming for about 15 or better. So it's a little bit low by that standard. And that's it. That's all I have. Any questions?
Haney?
Yes, ready.
When I noticed a couple of years ago, I owned this stock for a few shares.
Oh, okay.
I think December year end, I cleaned up, thinking that it's not going anywhere. It is very steady and stable and a very dependable company, but it's not the
It's
growth
not
rate.
growing.
Yeah, it's not growing. So I just sold my shares in December. It is a company on the same street. I used to have a mainframe computer and still some nuclear fuel facilities still there. So I was surprised to find out that it's so close. Then company is doing good, but I bought some shares. The growth is very, very steady. It's not growing. I do not know why. It's all software and the big company and big and large number of employees. A very steady business. Very, very steady business.
Yeah,
But
let me show
it's not
you.
growing.
No, let me show you the. So this is. I'll just do 5 years here. This is the
Yeah,
stock price over 5 years. So to your point, if you would have bought it here, This is like around $60 here. Yeah. And right now it's at 61 over 5 years. So you really didn't make any money. I mean, if you sold
Yeah.
here, fine. But yeah, to your point, I think the reason for that, I would guess, is because their main, because I was in this business, as you know, not IT, but I was in engineering consulting. And in a consulting company, it's very difficult to grow. There's a lot of hurdles to growth, and you're basically selling time. And so the only way that you can grow is to do very, very large projects that don't require you to sell time. So it's like working, in the service industry. If you're getting paid by the hour, the number of hours you work is what you get paid, but there's only 40 hours or whatever in a week. So you're limited by that, and that's probably why these guys are not growing.
Yeah, I don't know, but the building there looks small, but I do not know where all their employees are. But it's a good, very stable, steady company. But growth rate was I could not understand. So
Yeah, no,
uh,
that's a very fair comment. I mean, if I go, let me do. Okay, so if you held it, I don't know, this is like 10 years. Yeah, you could have done okay, I guess, but not probably not relative to the S&P. If you had the S&P, you would have done a lot better. In fact, I can probably do that. SPY. Let's see. Yeah. Well, okay. Well,
Recommend
I'm wrong.
buy.
I'm kind of with Ready. I would not recommend buying this company at this point. I think they're.
And then
Mhm.
Oh, I was just wondering, what was Jay's recommendation on Hearst?
The reason why we're presenting these two means mostly the SNC as to show as a competitor of the Genpact. So Genpact is a bit stronger performer compared to SSNC.
Here's versus the S&P over the last 5 years, and we know why the S&P has gone up so much over the past 5 years, and not even 5 years, but like starting in 22. So it's because of AI and NVIDIA and etc. So I think you will probably find most companies, with a few exceptions, like the Microsofts, the Amazons, and so on. You'll see this kind of growth, and everybody else is like this, with a few exceptions.
Henny, can you show the stock price for Genpact?
Yep.
I know Joanne has a gavel. I should not talk much, but compared to this company, it is 210,000 per revenue per employee, whereas Genpact has 31,000 for employee revenue. Okay.
Is that the revenue that they generate per employee?
Generate per employee. I do not know the standards between various types of companies, but these both are IT companies. And one is over 200,000 per employee. Other one is 30,000 per employee. Okay.
What's the other one called?
Genpact. G.
No, no, I know that we did that. What's the other one that you're referring to?
The one you presented, Henny.
Okay. No,
Yeah.
you said.
I think the difference, just like you said, Henny, it could be the employees are located based on where are these employees are. Different countries have different living costs and pay.
Yeah, I mean, like this is going back a ways, but
But what he's talking about is how much money the company makes per the employees that they have,
No,
not about
I
how much, not about how
Yeah,
much money the employees make,
you know,
how much the
generally,
company makes
generally,
per
I
employee. That's a different thing.
no,
yeah,
It's
I
not
generally
about,
understand.
it's not a, yeah, it's not about income. It's not about the employee income.
Yes,
yeah,
no, I
generally,
understand that. I understand
generally,
that, but hold on a sec. So when I used to run a consulting business, and we opened an office in India,
Mm,
and we had about 200 employees,
mhm.
and the average hourly wage for very skilled labor in those days for engineers, wa- and this includes the building, it included their computers, their benefits, and we were giving them really good benefits comparatively speaking, et cetera, et cetera. So their all-in cost was
Right.
$15 an hour.
Whoa.
And
oh,
when we were, not anymore, I know, not anymore. But
I'm
no,
hearing,
let me make my point. So when we were the revenue per employee, if you averaged it out, we were making a killing compared to North America.
Right.
And
Yeah.
if you take the overall picture, so you have to kind of look at that. Now that's not the case anymore. India
No.
and China and so on have gone up, but there are jurisdictions around the world where labor is a lot less than North America. So that may explain it. So I don't know if that's a very valid metric. I think you have to look at the profitability of the company as a whole.
Right. Yeah.
Okay, so we're nearing where we need to do guest comments. And actually, can I just go quick through the questions here? So Brian Koenig said, look at the this is, I guess, for G. Look at the taxes paid for 2023. That's what is taken from pre-tax profit to get to the net earnings, which is divided by shares outstanding. So it's the taxes paid. And then he says, see the taxes paid for 2023 were NMF. That's the increase in net earnings. And then he says for value line, he says he knows that only one analyst is listed as the one that's listed on the form, but does that mean only one analyst did the analysis, or is that a team that did the analysis and that person signed off on the,
My
you
my understanding, Brian, is that it's one main analyst. He may have like juniors or interns or what have you, but it's primarily one person at Value Line that is responsible for a company. Because I just asked them a question recently, and they said, "Oh, we're going to go back to the analyst and get that information." And they never got back to me, but that's okay. Somebody else asking, how does a club member come to select a particular company before they do the deep dive? So we typically, it's not one member. We typically have a small group that does a stock study, and they'll use various approaches. I just showed one approach. It could be, we have a watch list of companies. So you could pick from that. Sometimes we're missing a sector, so we look for something in that sector. But it's a group decision on what we decide to study. So in this month, it was Jay and I. That was the group. So you got two opinions. But in all honesty, guys, I'm not convinced by either one of these companies. I think there's probably some other alternatives.
Yeah.
Out there.
Neither one of them look real sparkling.
No.
Yeah.
Growth rates are pretty low, but
Should we go to get guest comments now?
Yes, please join.
Okay, I'm going to unmute Azza.
I'm going to
Hi,
give you
Azza.
back my screen.
I don't have, well, let's see.
Sorry?
Okay, it'll just go to the agenda.
Oh, okay.
Azza, are you there? Go to Brian. Hi, Brian. Oh, Is somebody unmuting him? Because every time I click on it, it.
Oh, yeah, another good meeting. I'm going to look at the online to go back over what the 5321 and that information that you put out there. Another excellent meeting. Thanks a lot. And those are just some my questions were more or less thoughts of what the increase in earnings might be. Thank you.
Thank you for
Who's next, Joanne? Is Joanne there? Joanne?
this. Let's see. Oh, something happened to her. Let's see.
Okay.
She's not. Do you want to just carry on?
Sure. So the next person is Helen Albanese.
Yeah.
Helen, are you yourself muted? Okay. Oh, she has a question. No question. Thank you. Okay, thanks. Next is Janet. Janet, do you have a question or comment? You're self-muted as well.
No, I don't have any question.
Okay. Do you have any
What do you
comment?
think of our meeting, Janet? Janet, the director of the online chat.
I'm sorry, what did you say?
What do you think of our meeting?
I think it's a great meeting. It's very good. Yeah, I enjoyed it tonight.
Thank you.
Lots of
We've
good
had-
information. You analyze a lot deeper than I do, I think, sometimes. Maybe because I've been doing this for so long, but yeah, but I think it was a great analysis.
Thank you.
Milburn Crozier is next.
Here, a good meeting. I guess the real detailed analysis of, the cool, I forget what you call it, and some of the other analyses. It's very quite detailed. I guess I was a little confused about how you chose the companies to look at. Software companies, I guess, are a bit out of favor right now from what I hear, and maybe actually is a good time to invest in something like this because perhaps there will be a downturn. We've gone a long way without a downturn, and from what I'm hearing, the mid caps and actually the stocks you're looking at probably will do good when I guess the markets kind of equilibrate. Anyway, that's my 2 cents worth.
Yeah, I don't blame you for being a bit confused as to how we selected these because we were confused ourselves, and it was kind of hard to find something. We started out with the BI screens, and then when we looked at the initial list, it wasn't that great. So it was kind of, we went around in circles a bit before we landed on these two. We came across them as competitors to some other companies that we thought we would be studying. So and for some of the same reasons that you mentioned as well about software. So I have a question, Jay. You mentioned that you use Cy Lynch's methodology. I'm not familiar with that.
Yeah. Silent, it's under education topic. I also presented as education topic to the club. So Silence has a PowerPoint. I can put the link as I shared. I think I don't know if that information still, sometimes things can be outdated, but I'm still using that methodology. He just wants to make sure second check your answer. I can check your answer. So he was using value line as a projection to calculate, to double check the pre-tax profit, your outstanding share. I can go to our Google Drive to get that
Okay, I
PowerPoint.
can talk to you about it later. But I just
Yeah.
the thing I mean, I called Value Line recently because I got confused as to when they're projecting, it says 3 to 5 years, and then there's a box on the left-hand side which gives you the growth rates. And
I don't look at those.
yeah, if you I mean, the two should somehow be close, but they never are, and it just depends on which of the 3 to 5 years, both your starting point and your end point, that you're going to use. And you can get some pretty different results. So that's my struggle with Value Line most of the time, and that's why I try to go and pick all these different earnings from different sources.
So,
I think he did mention don't look at the box to the left. I don't look at those numbers. I'm basically looking at the 27, 29. The way tonight we look at the earnings per share.
Yeah.
We look at these numbers, projections. I don't look at the left side. I don't
Okay.
look at those. I just shared with you all, including the guests, silent presentation, and it's how can I be sure?
Okay.
so is that the consensus, to not use the left side of the value line? Value line
It really depends on who you talk to.
We depends on who you're talking to. Yeah. I don't.
Because
I used
different
to.
people
but
in BI some people will tell you in BI will tell you to use the numbers on the left. Some will say use the numbers on the right. So
Right. Yeah.
it really depends.
Yeah.
It's kind of your choice. It ends up being kind of your choice.
So why are they different? Honey, what did you?
Like Hanny, I don't really understand why they're so different. It seems to me that they should be closer together also, but they're not.
Like the numbers on the right, the numbers on the right are usually some sort of discounted cash flow thing, and then I don't know, it's all proprietary, but I think they have a model of the financials, and then they make some assumptions if sales are this much and taxes are this much and so on, similar to the preferred procedure. And then they come up with a number, but I don't know how they come up with the ones on the left. I really don't. And I mean, I called and I asked them that question specifically, and they said,
they're never going to tell you. They're never going to tell you.
Well, they said we're gonna talk to the analyst, and I gave them Apple as an example. I said, here, use, that's a company that everybody analyzes. So just so they never got back to me. So maybe I'll give them another call and see if I can get to them. But
funny stuff. Funny stuff.
Okay, so I don't know who's doing the next stock study, but we should probably look for something because we've got a big cash hoard, and we should probably deploy it. And,
well, is there anything that we have that we currently have that we can buy?
Yeah.
That's the other.
So
I mean, the other thing is the stock prices are going up, so it might be a bit difficult to find something that's really at a quote reasonable price.
Yeah, that's the problem.
If the S&P and whatever are hitting new highs every week, finding a reasonable price is not going to be easy, no matter what it is.
But the odd thing is that a lot of, that those new highs are attributable to just a few companies.
True.
Like Apple, for example, after they mentioned Apple Intelligence instead of AI, their stock went from, whatever it was, 175 or 180 to 213.
The 27 times they mentioned it, yeah.
Yeah, and if you look at that market cap that change represents, it's equivalent to the rest of the S&P put together.
Put together, yeah. And then Nvidia just surpassed them as the largest company or something. So
yeah.
It's not even the Magnificent Seven. It may be the Magnificent Four or something right now, but
Okay, we have like 8 minutes left, and I just want to make sure that we have the people for the stock study. And I have Christopher down. Is there anybody else?
Interesting. I did not realize actually today there are three. We need a VP. I did not realize there are three quarterly reports. Call us
Oh, yeah,
and
yeah. So I think next month we can do we'll do the quarterly reports, LGIH, Qualis, and Vertex. And then Christopher, you're going to be on the stock study. Is Christopher still on?
Yeah.
yeah,
Okay.
he already submitted his Qualis. I'm wondering, Chris, maybe you can challenge LGIH. That was we talked about last time. Mina's company, that construction company, maybe should be challenged with DHI or whoever.
Does anybody want to be on the stock study with Christopher that hasn't been
can.
on?
Yeah, I can do it.
Okay,
Jane.
Christopher and Jane. Okay, and now,
Not challenge at GIH.
okay, and Mina sent a message out to Anitra, Isla, and who else? Did you guys get that, your message?
Yes.
Okay, so you've been assigned.
That's,
This is something we need to talk about.
yes, we do.
So
Oh,
we
yeah.
need to talk
No,
about
I did not get it.
how you want the club to continue functioning. Henny has a comment too. Henny, you can go ahead. You want to say something?
Yeah, I think like you know, in order for us to have a properly functioning club, we each have to really get involved and contribute. And because you want to have a diverse set of opinions, a diverse you know, backgrounds, and so on and so forth. And that's how you make good decisions. If it's just the same people that are presenting and talking all the time, then you kind of you get you know, down a certain path that's maybe you get blindsided, and you don't necessarily have, you know, the benefit of a large group. So I think we really need to get more people involved and engaged in doing studies and doing education topics and so on. So if you
And the leadership, more importantly, it's the leadership. We're kind of having the same people in leadership, and I think it's time to start, you know, having other people step up. Yeah.
that's a good point.
Okay. So this message was from Mina. He said it went out to Anitra, Isla, Christopher, Jay, and myself. You are receiving this message as you are the unlucky elite who have been targeted for executive nominations. Hurrah, hurrah! We're still in need of a new president, vice president, and secretary. Christopher, my understanding from our last meeting is that you may be interested in the secretary role. Is that correct? Please consider. Go ahead.
I thought Hanny was gonna be a secretary. Was I?
He's treasurer.
All right, he's a.
I'll do
Yeah,
secretary. Oh,
I
no,
can
you.
do whatever.
Okay. I think he should be the vice president.
Yeah, I can be the vice president. That's fine.
Okay.
Vice President is so easy. Chris, you are very good with the spreadsheets and very organized. You should do that.
I want to
Yeah.
know how
More than that, I think, because Chris is young still. The rest of us are not so young. This is a good opportunity for you to, you know, develop your leadership skills and gain more confidence. And you know, you have a good mentor in Joanne. If someone gets out of line, you whack them.
No, I
You know.
gently. But also, it's really great for your CV. It's great for your, you know, if you have an executive position on a club, yeah.
Christopher has been investing for the past few years now. So in preparation for a president, then he can become a vice president this year.
Yeah, that sounds good. Okay, so we got Christopher VP, Hanny for treasurer. So we still need president and secretary. Isla, what do you want to do?
Wait a minute, you're asking Isla? I know I won't be able to be a
I'm
president.
sorry. I
And
didn't even
how
hear
did
you.
unlucky and elite end up in the same sentence? I found the email. I'm still trying to figure that out.
Okay, so what did you want to be? Secretary?
Well, I can't be president. Yeah.
I'm telling you, president is the easiest job, guys. Is
it? Tell me
yes,
about
it's
it.
running the meeting. Basically it's running the meeting.
Oh, okay, I'll be president.
Yay, Anitra.
And tell everybody what to do. Just delegate. Just delegate.
Okay.
Yeah. So
And go on vacation.
So Isla, you're going to be secretary, and then I'm going to send you.
What?
Yeah.
What?
So I know.
I don't type well.
No, you're not.
There's no
I
typing.
Recorded it.
No typing.
No, I can talk. I don't type.
Okay.
You don't need to type. All you need is post the recordings on YouTube and Facebook. That's it.
Oh, gee, another skill. Okay.
Okay. All right. I'll be sending
One suggestion though, Joanne, is we should have like a handoff. So people that are have done this in the past should hand off to the new person, explain what the role is, how to do it, that sort of thing.
We'll do a meeting to establish the goals and yeah. I'll send out a meeting. It'll probably be on a Monday evening because that's kind of our regular. So oh, I don't know who that is. That's not me, is it?
Not me.
Okay.
Oh.
Okay. Is it Isla?
Huh?
So the guest.
Lucy,
Hi.
meeting. Cause.
Okay.
Hold on.
Do you have a comment? It was her.
I think she
okay.
left.
Yeah.
Okay. I'm signing off.
Okay. Have a good night.
Thank you.
Thank you very much.
See you next week or whatever.
Next month.
Like get some companies that we can invest, or maybe
Okay.
just existing ones or something.
Okay.
Maybe
Yeah,
what we need to do, is do a review of the entire portfolio and figure out that way.
I like that. Yeah.
If there's something that we can buy that we already own, because we're just piling up cash. We can't
Yeah.
find it. We can't find a new thing to buy. So maybe there's something we already have.
I have
Yeah.
a question. Oh, I'm sorry. That's true. You're right. I have a question.
Go.
What does a secretary do?
God only knows.
We have a rules responsibility. We documented. Secretary in our club basically is posting recordings, and I need to dig out that document. I actually don't remember on top of my head.
Okay, you post record. Don't you write minutes and things like that?
No.
Yeah,
No.
you're supposed to, but because our meetings are recorded, we felt there's no need. Ideally,
okay.
yeah, that's how we agreed on initially.
This looks familiar, this document.
Oh.
I think Secretary shall keep a record of club business, maintain correspondence, which we don't have, post meeting recordings, manage club social media, Facebook and Twitter,
Oh, good Lord.
The secretary manage the membership roster and prospective member lists. And this list shall be, so basically not much. Because we don't do anything on Facebook. We don't do anything on X, which is now Twitter.
Which is fine. That's not a bad
Yeah.
thing.
Yeah. So it's mostly
The
I think
YouTube thing.
YouTube and maybe, yeah, that's it. And just keeping track of the membership, like
Who puts together the agenda?
President, vice president.
the VP.
Okay.
Yeah, the VP.
Okay. Whichever one Isla wants, because the reason why I ask this is I don't have a problem with typing. And as far as, yeah, I thought that the secretary typed up minutes and things, but either one of them, but because, yeah, okay.
So there's my son showed me this, but there's an app now that you take to class and you just record the class, and then it generates a set of notes and a quiz. So it says this
Wait,
is
is
what
this
the
AI? Is this an AI
yeah,
thing?
it's an AI, and so it says this
Wait,
is what
and it
the
generates a quiz too?
generates a quiz. So it says this is what the
This is
professor talked
hilarious.
about, and here's a summary of everything, and here's like 20 questions. Did you get these concepts? Yes or no? And you have like these questions that comes up. So like the things are changing so rapidly, it's incredible.
Wow. So you don't even
That
have
is
to write
true.
notes anymore. Okay. All right.
No, nobody writes notes.
Well, definitely, I like that idea of what you're saying about it taking notes, not for children and people that are getting grades, but in general, it's a good concept. Is it dependable like any other parts of AI isn't all dependable?
Yeah. Do they understand everything that's being said, and do they write down the important stuff?
Well, so
That's
so I belong to a club. It's a sailing thing, and we teach like safety and sailing courses and things like that.
Nice.
And we had a meeting. We had a general meeting, and nobody showed up. It was just the executive. And I said, we need to engage more with the members. And I said maybe we should write a newsletter. And everybody jumped on me and said, "Oh, well, you should write it. And do you have time to write a newsletter? It takes so long." And I said, "Okay, well, we adjourned at 9:00. 9:30 I was home. 9:45 I sent out an email with a sample 2-page newsletter.
Oh my.
And I used ChatGPT and I just said, write a newsletter for this sailing club. Here's the name of the club. These are the events that are coming up. Make it friendly, whatever, blah, blah, blah. And it wrote 2 pages.
Wait, you
And
said make it friendly?
yes, you can tell it what tone to write.
If you want to holler at somebody, does it do that too?
No, you can actually, like, you can take part of, say, Donald Trump's speech or Joe Biden's speech and say, make it sound like this, and it will do it. And you
Oh my goodness. Make it friendly. No, holler at them. Tell them they did something wrong.
No, but the point is,
Hilarious.
it's just, like, this stuff is so advanced.
There's software out. There's an app for that. Whatever it is,
Yeah.
there's an app for that.
And there's like four free ChatGPT like programs out there that you can use to do whatever, right? And
Wow. That's true. That's amazing. That is amazing.
I mean, I'll send you. I'll do a sample of something. I'll send it to you.
Did your club members like the newsletter?
Yeah, they said you're a genius, and I said no, I didn't do anything. So
Don't say that. You did too. You did too.
No, it took me longer to write the email to them than it did to write the two-page newsletter.
Should have had ChatGPT do that too. Oh my God. Oh my God, we'll do nothing next. What is going to happen to our brains when we stop yet having to use them?
Well, That's another issue.
What's the name of the app you mentioned?
Oh, yeah, we want to know the name. We
regarding,
definitely want to know the name.
Which
Google
one?
that.
the summary and quiz?
Oh, well, you can, it's called Otter AI.
Otter? OTT?
Otter, I think. Yeah. I'll
Like-
check with my son, but I'm just going
Like
by
animal
memory.
otter?
I think so. I'm pretty sure.
That's it. It says AI meeting note taker and real-time AI transcription.
Yeah.
Oh, we love
Otter
that.
AI.
Okay.
But if you, I mean, like if you have notes or if you have a long document, if you have an annual report from a company, copy it, put it into Chat GPT or Claude or any of the Gemini is good, and it'll summarize. Tell it, give me a five paragraph summary of this, and
Wow.
it'll do it.
Wow.
If you guys haven't used this, you really
I
should
haven't.
just play with it. It'll blow your mind.
I bet.
I've used AI for information for stocks that I can't find.
Yep.
And yeah, it did answer a question. I asked how long Google, I think it was Google, either Google or Microsoft was in business, and it gave me the wrong answer, whatever it was the wrong answer. It was like 20 years, 2004, and that wasn't correct.
That's
but
Google.
But I've learned that you have to be particular with your words. You have to make sure you're asking something as simple as you can make it, so it will give you the information you're asking for. Because you might say something and think you're saying one thing, but you're not. You didn't really say that. You didn't say it correctly.
It's called prompts or prompting, and they're now teaching courses on how to prompt these generative AI, large language models to get the right answer. They'll give you the right answer, but you have to ask the question in the right way. And so that's a new skill set, I guess, that people are learning, is how to prompt.
What are they going to do about the answer that the person said, what do I do about having the cheese slide off my pizza? And they told them to put glue on it.
Well, they didn't tell them to drink Lysol, so what can I say?
Put glue. I mean, it's a silly question, honestly, but it does demonstrate that, the large language models don't exactly know everything.
No, they don't. They're learning, right? They're learning, and it's the compute power that they're coming out with, all these NVIDIA chips that run these things. That's what's going to drive like the advancements, and that's why they're paying like literally hundreds of thousands of dollars for these chips, because everybody's racing like to that. And the scary thing is, I'm waiting for all the big investment houses like the Goldman Sachs of the world, and when they start using AI, which I'm sure they have, to select stocks, the rest of us are screwed.
Hey, Nate.
We'll probably do a better job.
Oh, hey, Nate.
Yes, sir.
Hey, did you see the 60 Minutes episode last week? This past Sunday?
No,
Yes,
I missed it.
Okay, they had the guy who originally wrote his PhD thesis from England about generating neural networks in computers. Yeah. And so anyway, he was going on and about it, and he was saying, oh, these things might get intelligent enough to take over and all that kind of stuff. But the problem, the thing that right now about generative AI, it's all based on language models. And it's based on the statistical probability of predicting the next word, right? So it's really kind of takes account of the language. It's really thinking about grammatically correct sentences. Does it make scientifically correct statements? That's irrelevant. It's grammatically correct. That's what they're interested in, as far as we know now. So but
people are going to ask scientific typed questions.
That's right, because they could, like, when one got to choose stocks, and we'll do a better job than they can.
We will.
Remember Leslie Stahl when she did her 60-minute interview, and they typed into ChatGPT or whatever the heck it was, and it says, okay, Leslie Stahl. It came up with a resume of her history, and says, well, I wasn't born there. I didn't go to school there, and ABC was not the first place I worked. It was CBS.
Okay, but
That's not my age.
But I don't know if you've. There's a book called I think it's The Man Who Solved Wall Street or something like that. It's about Jim Simons, and he was a PhD mathematician. He died recently, and he was recruited in the he ran the math department at Princeton, I think, or something. I can't remember exactly where, but he was recruited by the CIA to break Russian codes during the Cold War. And then after he did that, he decided that he wasn't really interested in that stuff, and he wanted to start a hedge fund. So he hired all these physicists and mathematicians who knew nothing whatsoever about investing. And his hedge fund, from the time it started for about, I think, 20 or 30 years, was making 60% return per year.
Oh, wow.
And all they did was they looked at patterns in the market. And when he was interviewed and they asked him, well, how do you pick these companies? He says, I have no idea. We don't pick them. We let the computer pick them. And it's all based on patterns and price patterns and so on and so forth. And he did that for 20 or 30 years. The fund's name was, I think, Renaissance. I started reading the book. It's really interesting. And he's got a better return than Warren Buffett, Peter Lynch, anybody that you'd care to name. 60% return per year, just looking at patterns in price. And they only hold the stocks for, like, they'll buy 500 stocks. They'll hold them for 3 days and then sell them. And it's all done by computer.
Yeah.
I was wondering if they had. Okay.
Anyways, I better go.
Okay, so Isla's the president, and I'll be.
Oh, no. No, you don't want to do that.
Why?
You honestly don't want to do that.
Okay.
That is definitely not my forte at all.
What, the secretary?
For the president thing.
You don't?
No, not me. That's not me at all, ever.
Well, you're very organized. I really enjoyed your presentation tonight.
Oh, well, thank you. Took a few days to get it together, but you know.
Well, it was great.
It was fun. It was really fun to learn all that stuff because I had no idea.
I can't wait to go over it. And then I need that Otter AI to do a test for me and make sure I understood it.
To come up with to summarize it and come up with a quiz. Oh my God.
Yeah. Okay. So when does all of this start? I guess you'll be talking to whoever has the position.
Somebody, I think they'll send out an email and we'll try to have a meeting and figure it all out then.
Okay. All right.
Okay.
Joanne, are you there?
Oh, she may have gone. She may have gone.
Yeah.
She may have left. Let's see.
No, she's still on. She just might have walked away.
She might be muted, or she might be away from keyboard.
She's not even muted. She just probably walked away.
Yeah. Well, yeah. Okay.
Are we the only ones that weren't doing anything?
Well, I guess we're the only ones who are talking.
No, they weren't doing anything. So everybody has a position.
Oh.
Well, no, we were the lucky names that came up.
We're the unlucky elite.
Yeah, the lucky elite. Yeah, with the elite. I like that.
Didn't make sense. That is.
Stroke them a little bit and then they'll be happy to do it. Yes.
It's just about time we just want to have a rotation,
Yeah.
to be part of this.
So but we still need to have that kind of a meeting thing to figure out how it's going to work.
Yeah.
Okay. Good job.
You
Good thing,
basically,
good
for
thing.
this group, the leaders will come up with what are the goals? What do you want to the club achieve? What things you think that we should do differently or should do better? Or
Do you
Joanne will
have
set up.
meetings? Do you have meetings just for the select few? Do they ever get together and talk out? They have to get together and talk outside of the club, or it could be done by email, huh?
Yeah, Joanne will set up.
Okay. Sounds like a plan.
Yeah,
Okay. And who's talking now?
we're done talking.
I think we're.
Oh,
Meeting
okay.
adjourned.
All right. No, yes, meeting is adjourned, but I just wanted to say I am so glad that I pulled out of the what was it? The study this week. I had to have a procedure today,
Oh,
and I'm gonna
everything's
have to have
okay?
another. Well, not well. It's not bad, but
Okay.
it didn't work, so I'm gonna
Oh.
have to. But it's not as painful as it was. So yeah, it was a rough day, but not a bad rough day. Just a shocker, I should say.
Yeah. Mm-hmm.
Yeah. So okay, well, I will. Can't wait to listen to the recording. It's a lot to learn.
I know.
All right.
Did
Thank
anybody
you.
ask Reddy if he'll be able to do the treasurer's report next month because he's moving?
Henny will do it.
Okay. All right. Because I was wondering about that
I'm
today.
not sure. That requires some coordination. We'll figure out.
Yeah, because if he's moving, he might not have
Yeah.
time.
Yeah. Okay.
Okay. All right.
Okay. Alrighty. Have a good night. Thank you,
Okay,
Piero,
everybody,
for
have a good
stepping
night.
tonight.
Thank you,
Thank
everybody.
you.
Yeah. Good
Good
night,
night.
everybody. Oh, can I
Bye.
send a message to Joanne? Joanne, can you send that link to the